and welcome to Move Conversations. This is your host, Venkat. In this episode, we talk to Ms. Lakshmi Kumar, Policy Director at Global Financial Intelligence, USA. She specializes on the issues of financial policy, securities investigation, regulatory governance, anti-corruption, and anti-money laundering and terrorist financing, including trade-based money laundering and real estate money laundering, and so on. So recently she co-authored GFI's report, Acres of Money Laundering, Why US Real Estate is a Kleptocrat's Dream. The report highlighted why US real estate market is a preferred destination to hide and launder proceeds from illicit activities. She has a Master's of Arts in Law and Diplomacy from the Fletcher School at Tufts University and a BA LLB from Nalsar, University of Law, Hyderabad, India. Welcome to the show, Ms. Kumar.
Thank you so much, Venkat. It's a pleasure to be here, and I'm looking forward to your questions today.
Thank you. Ms. Kumar, let's begin with the basics. People often say tax avoidance is not tax evasion. What is the difference between the two?
No, that is a fantastic place to start, because the best way to sort of differentiate the two is that tax avoidance is legally permissible ways to reduce your tax liability, and tax evasion is illegal ways to reduce your tax liability. That is at its nutshell. I will say there is a broader philosophical question couched into it. And I think that's often been the subject of a lot of discourse more recently, is that in tax avoidance, in the rules that we have as they are right now all over the world, are those rules fair? Because sometimes it feels at a philosophical level that there are one set of rules that benefit the wealthy, the high net worth individuals and ultra high net worth individuals of the world, and there is another set of rules. And so I will say, as I talk about the difference, but also say that there is this larger issue that is baked into it as well, and it is not as simple as it would seem as it does on the face of it.
Right. So then, where does the concept of wealth protection fit in here? What is it, and what structures and mechanisms do the wealthy use to protect their wealth from being taxed?
Again, absolutely right. When when we talk about the terms wealth protection, it is really just a synonym for the word tax avoidance, or if you are very underhanded about it, it is a synonym for the word tax evasion, wealth protection. So it's a question of, how far you want to stretch it. And a lot of it, essentially involves, as you said, the structures are key, but it is being able to take benefit of jurisdictions or countries that specialize in protecting your assets, which one can mean a couple of things. When you use the word asset protection, it means that one, it is not subject to taxes, which means you can protect wealth for generations. Two, It is not subject to being attached in a lawsuit. And this often comes up when there are divorce proceedings. If husband or wife, or two spouses in a marriage or relationship, civil union, and it dissolves, are looking to protect their individual assets that they've earned. And so that's another way you move. But what a lot of it does, in fact, is that it involves the movement of assets or money out, usually from your home country to another country. So let's say you're based in India, which is right close to Singapore. You move your money to the British Virgin Islands or Jersey or somewhere else where they have laws that protect it, where there are professional services designed to protect this. And so that's one, is the jurisdictional element. The second element is the structures. And so you have trusts, LLCs, Panamanian private invest foundations. These are designed to protect your assets, often hide your assets from scrutiny from elsewhere. It may, in some cases, may also mean because you're able to shift assets outside. It is not always clear how often you're declaring these assets back to your taxman in your home country. And, this is not to say that people then also don't use art, buy expensive paintings, jewelry, yachts, homes, houses. These are, stocks. These are all ways to sort of diversify your asset portfolio, but also protect your asset portfolio.
Right. So, few weeks back, the Pandora papers were revealed and, were released. And when the Pandora papers came out, it was shown that South Dakota was a $367 billion tax haven, rivaling other famous tax havens. What makes it an attractive location?
That is a question that is puzzling many at the moment. And, it's not something you conventionally think as the go-to destination of the very rich. There aren't the lifestyle choices that, let's say, Monaco or Switzerland will afford. Correct. The very rich. But what South Dakota does have is it has very friendly laws. It has had these, and this is, a product of living in a country like the US, where states get to make a lot of these laws. It does not come nationally. So it is not one law that applies. So states really are able to make laws that boost revenues, that protect them. So in many cases, these trusts are designed to be generational trusts, so they can be held in perpetuity. They are tax-free. There is a way to obscure and hide your identity because you don't have to declare. There's no transparency around it. It is not easily accessible, this information. It is an industry that is therefore shrouded in much secrecy because it is not regulated at the federal level. It is only regulated at the state level. So it doesn't have the same kind of money laundering and corruption scrutiny you would have had if it is regulated at the state level and the federal level. And the thing above all to remember is that whenever we see money being hidden, there is a great connection to both history and geography. And with the case of the US and South Dakota, there is this preponderance you've seen of it being marketed and advertised to the political elite or high net worth individuals in the Latin America, Caribbean region. And for both historical and geographic proximity reasons, the US is a preferred destination to put money, to hold assets, because it provides ease of convenience. It is the largest economy in the world, and it is access to the US financial system means access to the rest of the world's financial system. You won't necessarily see Latin Americans putting their money in the UK. That, it doesn't have the same historical ties. It doesn't have that same geographic proximity. Correct. But the US does. And that's something to also consider when you look at South Dakota, because in the aftermath of the Pandora papers, and even prior to that, one thing that the trust industry seems to have done is marketed itself very well in Latin America. They are a known commodity in a way that, let's say maybe the UK is more marketed, or BVI is more marketed in India because of its historical connections. Or Africa, or the UK is
Middle East, Africans,
Middle East, Africa, South Asia, because of its historical ties and how it connections is much more centrally located than South Dakota for a lot of people based in that part of the world.
True. What puzzles me is that way back in 2009, Switzerland agreed to reveal the names of some 4,400 plus wealthy American clients to UBS, to US authorities. That blew open the Swiss banking secrecy. And more recently, I think about 3 years ago, there were headlines like the era of bank secrecy ends as Swiss start sharing account data, and which meant like other countries too, in addition to USA. So are you saying US blew open the Swiss banking secrecy, but has alternative facilities in the US itself? So what happened to the principles espoused then? And in what way are US regulations, say, for politically exposed persons or others, not in line with these international best practices?
So that's a couple of questions in one question. Sure. So I'm going to try and answer them one by one. Sure. So on the first question, on sort of the role of what it means and the fact that the Swiss banking industry. So what I will say is that it's interesting is that there has been a significant banking reform, whether it's on the side of Switzerland, and there was a problem with Swiss accounts clearly, but also on the side of the US to make sure there was equal reform. I think what Pandora Papers has really sort of exposed is the wealth management industry. And it's exposed the role of that, whether it's in Switzerland, which I think everyone knew and suspect. I think what it has also provided, exposed and evidence, is South Dakota, which a lot of people were not familiar with and just did not know that it was a hub of so much activity. And I think this really goes back to the heart of the issue, at least in the US, is because it is a federal country. A lot of this, and if you look at the way the Financial Action Task Force has evaluated the US, there's a clear distinction between the approach at the federal level, where they see this as a risk. They see sectors like this as a risk, where at the state level, this is just a way to bring money into the state and the economy. No one is thinking about, is there a corruption risk? Is there a risk to US national security? Is there a risk of money laundering? No one is thinking about that. Now, on the question of politically exposed persons, it is shocking in that the US does not have a clear definition of a politically exposed person. It is something only the banking sector, because of how vast the US banking sector is, so the banking sector has taken it upon itself to look at internationally what's going on, develop it. But the US has not updated its politically exposed standards in line with a lot of other countries all over the world. So in that way, the US is really lagging behind, but in some ways it doesn't matter, because the requirements on politically exposed persons only apply currently to the banking sector. And so it's a huge problem when you see, the trust industry or the real estate sector and politically exposed persons invest in it. But there are no obligations for the people that are responsible or the frontline managing those industries to actually check. So it's this complicated scenario where these people who should be checked aren't checked, but there is also no guidance to help them check. So that means we're effectively doing nothing as a consequence, and that's what's happening with the trust industry. It's happening with the real estate sector as well.
Right. So that is a good place to segue into overseas real estates. Why is that a preferred route?
And this in some ways it ties back to your previous question, which is about the banking sector. As you rightly said, for decades, you could dump your money in a Swiss bank. No one would ask questions. You could dump your money. And, again, because, in Singapore, you're so close to the Philippines, the Marcos family scandal is well known. What happened with the Marcos family in the Philippines? They parked their money in bank accounts. You cannot easily do that today. You have to have a bank be complicit, willing to hide. There are many more hurdles to be jumped. So if you're someone who has a lot of money, not all of it is gotten through legal means, the next place thing is you want a way to protect that money. You want it to retain value. So you don't want it to lose value. If you can make a profit off of it, great. And in many cases, you want it to be accessible for future generations. Now, real estate does all of that. Real estate is stable. It often will turn a profit. If it's located in a stable country with a strong rule of law tradition, it means your money will be protected. If you are a corrupt leader from a country that is authoritarian or doesn't have a democratic structure, it means the next person in power will steal your money if you keep it in your own country. So you move it to a place where the courts will protect it. There is and also what better way? You get to flaunt your wealth and all your money in this beautiful palatial home, but at the same time, no one really asks you questions. And that's the other thing, is that it has all these benefits, but it has no measures to check illicit money coming in. And so therefore it becomes a perfect vehicle, because, they often say if you buy a car, the moment you take it out of the showroom, it loses 50% of its value. That doesn't happen with the house.
Right.
And,
right. So So what are the secret structures that real estates in the US offers? Also mentioned that all cash purchases are possible. I mean, how is that even possible? I mean, common people, if they take a little bit of cash, they have to answer 50 questions, right?
Yeah. That's absolutely true. In the US, if you look at whether it's with residential, the numbers are somewhere along. We've had sort of various statistics over the years, but all cash purchases can range anywhere between 19 to 29%. And we saw that, for purchases of commercial real estate properties in the US, if it is under 2.5 million, 58% of all those purchases are done by overseas buyers and all in all cash in the US.
Wow. Huge numbers.
It is. They are very, very huge numbers. And that tells you the amount of money that's flowing in, the fact that it's a lot of money from overseas, and the fact that there are no questions being asked about. So the fact that like Theodore Obiang, who was making $4,000 in salary, was able to buy $100 million property portfolio without any questions asked in the US is how you end up with that situation.
Wow. Oh my God. Right. So we talked about real estates. What about gold as a money laundering tool? What's unique about it? What kind of international transactions take place with gold?
You're absolutely right. I have to get to that question, but I just remembered you asked me about the secret structures of real estate, I have not answered that question. So I will answer that, then I go back to gold because it just came to my mind.
Sure, perfect.
So with real estate, really what you're doing is you're buying it in the name of an LLC. So in the US, if you buy a property in the name of an LLC, you don't have to put down your name. So if Lakshmi is buying something in ABC so the property is owned by ABC LLC. Currently, and this is something the US law is finally changing. I don't have to put my name anywhere on it. I can put my lawyer's name, I could put someone else's name, but I don't have to put my name. So for all intents and purposes, it just looks like the house is owned by this LLC or this trust, and you cannot tie it to me. The other problem with all of this is that for the very wealthy and very rich, they're not doing this on their own. It's not like you or me when we try to purchase a house, you have to go to 20 different homes and stand and talk to the realist. No, you have a lawyer, you have someone you hire. And so very often the people who are helping people hide the money are people whose job is to protect the rules, to protect the system. And because they know the rules so well. And there is that relationship. Like for instance, we saw that for people that are laundering money, over 80% of them use like an LLC, a corporation, or a trust to hide identity as a way to buy property without anyone knowing. And that tells you sort of the role is to provide as much distance as possible between you and the ownership of that property, and that's what it's doing.
Right. So back to the gold question. So what is unique about it, and what kind of international transactions take place with gold?
This is a really interesting question because this is something I have once struggled with and long tried to articulate, which is that gold is not new. I think if you're South Asia, if you're anywhere in Asia, Middle East, it has a long association. I mean, the Indian government has tried since independence to make Indians buy less gold. It is a measure that has failed miserably in the country. And what has happened is, and the reason it's gotten attention is that I don't think for many parts of the world that gold is used to hide money or is used to launder money is a new concept. But I think what is different is that in parts of Africa and Latin America, gold mining has been tied to drug trafficking. Gold mining is tied to armed conflict. And that is why there is this growing interest in the US and in Europe about the role of gold. Now, added to that, gold is during the pandemic was at its highest price point ever in its history. It is low weight. easy to move. It's of high value. And in addition to that, unlike if you're trying to move drugs or something else, which is illegal, gold by its very nature is legal. And
Correct.
once you export it and move it to another country, you can't tell if that gold was mined by a drug trafficker. You can't tell if it was done in a place that is funding armed conflict. And that's what we see. You see gold moving from places of, for example, like you'll see gold moving from the Democratic Republic of Congo, but it'll be smuggled into Uganda, and then it'll be slapped with the Ugandan label, and then it'll go to the UAE. But then when the gold is coming to the US, it'll have a Swiss label on it. So everything is hunky-dory after that.
Mm-hmm.
And that's what we see really with gold. But what this, I think, issue negates is that the focus of gold and the use of gold is primarily seen as an issue of conflict and environmental damage in the US and in Europe. But the truth is, India and China are the largest consumers of gold.
Absolutely.
Indians have more gold than the Federal Reserve has gold.
Yeah, true.
And the narrative of being used to fund conflict or causing environmental damage is not something that appeals to in the Indian within the Indian policymaker apparatus, or same thing with China. Both of them are concerned with how much gold is moving in and out by its citizens. And so, having to reframe that conversation around gold, I think, is important for it to have an impact, because India and China will continue to buy gold without any problems. It doesn't have the same associations. The desire for gold is more than someone going to ask someone, have you sourced this ethically? People culturally are not going to ask those questions. And I think making that distinction is of vital importance before it's the art of, policies may be the same, but the way you package them and the narrative you create around them have to be different. And that's what we're really seeing when we talk about the issue of gold, especially.
Right. In your report, you have a case that interestingly connects gold and US real estate. You mentioned that a fugitive jeweler from India has apartments in New York held in the name of a trust whose beneficiaries are his family. So tell us more.
Absolutely. I mean, this was a fascinating case because it's the case of Nirav Modi, it is India's largest trade-based money laundering scam. I mean, it is fascinating because he was considered this real upstart jewelry merchant who was going to, India produces jewelry in most of the world because it has artisanal talent second to none. But at the same time, his idea was to sort of make the Indian jewelry label more international. And the truth was he was submitting false invoices and managed to defraud a collection of 30 banks, which the government in the end had to bail out. And all of that money, he was able to park it and hide it in real estate, which he continues to own. The government has not yet been able to get back all of it. So, because there is the question of having to now prove that the money that was used to buy real estate can be traced to all of these funds that he defrauded the Indian nationalized banks of. What he then was able to do is to protect the assets. He has created a trust, and the truth is, with the trust is what you do is the idea of a trust is that if I create a trust, I appoint a lawyer, he manages the trust, but the trust is for the benefit of someone else. Right. So he's giving that trust to his children, his family. But a lot of the times, you can still control the trust. If you give it to your children, it's meaningless because as a parent, you're the one that controls the trust. And this isn't the first case. We also saw the case of, Subrata Roy, who was accused of India's largest Ponzi scam. He defrauded millions of, of the very poor and nearly bankrupted West Bengal. He bought the Plaza Hotel in New York, which is such an iconic building. And it took the Indian government many years to be able to force him to sell it, use the proceeds back, repatriate those proceeds back to India. So you do see this migration of wealth, of money that's acquired through ill-gotten means being moved offshore, because it is a way to protect your assets, because it is harder to get the courts to enforce a legal claim in an overseas jurisdiction.
Right. So, a few days back, leaders of the G20 nations agreed to endorse the OECD deal on global minimum corporate tax of 15%. So we are sort of moving to the corporate side of this aspect. Does the agreement have teeth? Even if it is implemented, how effective will it be?
Oh, there's been a lot that's being said, and a lot of it is rightful criticisms, is that, yes, this is a global minimum tax, but this has been authored and led by the US and countries of the OECD. There's long been a question of why was the forum for this the OECD and not the UN? The OECD is a forum of rich, developed countries. Why should they get to set the standards? And none of the developing countries were part of the negotiations. There was no transparency. If you wanted a truly fair process, the UN is the most appropriate forum because every country has a voice in the UN. That is not the case with the OECD. And so, yes, there were multiple concerns because the truth is this 15% is not really 15%. In reality, it will become much lower. The fact that prior to this, countries like Ireland, which are a big tax haven, have finally signed on to it, tells you that there's no reason for Ireland to do it unless it protects their own country's interests. Additionally, a lot of developing countries wanted it higher than the 15% because they know they're going to get something lower. There's also the issue of, in terms of how distribution is going to be made under different pillars. And finally, the issue of digital services taxes, which is important as well. So on a whole variety of fronts, and I know there are a lot of developing countries have signed it, about 136. But as things are being implemented, what we are seeing is that, leaders within the G20 for Kenya and Nigeria haven't. And if you look at the original plan, there was an original plan that was actually put forth by India, which had the support of Ghana and a whole host of developing countries. They refused to consider that. The OECD refused to consider that plan. So yeah, the long and short of it is this, yes, it's nice, but what this really does is protect the interests of countries that already seek to gain the most from it. It does not protect the interests of countries that are looking to gain more and who deserve to gain more because they are still developing.
Right. Hearing the corporate side and more about the how the wealth management industry operates that you mentioned, right? My pet peeve is that, the common man, the salaried class, is regularly, if I can use the word, harassed by banks in quite a few countries, asking them, it's not about the first time you ask for the KYC. It's about update your KYC, maybe every year or whatever is the regulation, right? And for most of us, our details hardly changes. Maybe the employer changed, that's it. And our incomes and transactions are insignificant numbers. And in many cases, as they can just see from the bank account, the money that comes in is basically from the salary and so on, right? And barely people are able to balance the two, right? Income and outflow. And income and transactions are insignificant compared to the numbers that you talked about for the HNIs in these havens. Do you have suggestion that stop the harassment of the common man, but tighten it for the real fugitives?
That's a wonderful point. I can't tell you the number of times I've had my bank call me up and ask me if I am the real owner of the account, if there's a suspicious, why my transactions appear suspicious. The truth is there are ways that are inbuilt. Banks are supposed to take what is called a risk-based approach, which is, if you are a salaried person, your income looks regular, you are supposed to be considered lower risk, therefore subject to lower due diligence requirements. However, the truth is what we often see is that, banks are very risk averse when it comes to clients and accounts that don't offer the same profit margins and they are much bigger risk takers when it is clients and accounts that offer greater profit margins. And that, in a nutshell, is the answer to why you see less or more scrutiny sometimes.
Right. And they also say that, oh, central bank asked me to do this with this periodicity.
Yeah.
So it's also a policy issue, right? Why are it's I don't know, it's a pet peeve. So
No,
I'm
and
sure I'm taking the
what I
liberty
will
to say it like it's like this, right? Like imagine an aeroplane manufacturer, and if every employee every day is stripped down or patted down and search for possibly taking back a small nut or a screw or something like that. And it happens every day for them, but someone else has a mechanism to take the whole plane out.
No, and I think, the truth is the central banks very often offer policies, and the idea is that the risk-based approach. So if you are, let's say, a salaried person with a stable income, you should therefore be subject to lower due diligence checks. If you're a student and, unless you're suddenly seeing the student is getting, I don't know, $5,000, $6,000 a month, it makes no sense because this person is a student. So, they are typically subject to lower red flags. Now, the truth is, banks, the individual banks, because they want to get away from fines, are at liberty to decide how they want to rate and categorize risks. One of the things we also know, and this is true, is that, if you are, let's say, a customer that is transacting with what the bank considers to be a high risk jurisdiction. So if it's a jurisdiction with a correspondent, you automatically also, it changes your risk profile. And there is no question that, a lot of this is a part. And as you mentioned, not only is common people getting harassed, but the problem is that larger banks are slowly cutting off countries because they deem them high risk. So they're cutting off, South Asia, Africa, parts of Latin America, saying, we don't want to offer correspondent banking services to people here.
True.
Those are serious consequences of this risk-averse mentality if it's for a small account where the profit margins are small. But when you have like a Mexican drug cartel or these HNIs laundering money, no one seems to have a problem with the risk to reward ratio then.
Right. So it's more transactional and more theater probably, right? As far as the common man is concerned. Right. Great. Thanks a lot, Ms. Lakshmi Kumar. It was a great opportunity to get an insight on things which for most of us, we are once in a few years, we read it on the headlines, but don't get an opportunity to see the mechanics, what happens behind the scene and so on. And so it was absolutely a great opportunity to understand how these things work and why it is of concern both to the governments as well as to the people and the country's economy. We would definitely like to have you back on the time, or maybe we could pick a topic to do a deep dive another time. Thank you so much.
No, thank you so much. This was an absolute joy. And, it's always great when you get asked really probing, insightful questions. And this was a real pleasure to do. And I enjoyed myself tremendously and be very happy to come back another time. And, thank you for thinking of me for this.
Thank you so much. Thank you for joining us in yet another episode of Move Conversations. Hope you enjoyed this episode. Please subscribe to the Move Conversations YouTube channel and press the bell icon to get notifications of new episodes. Thank you very much. Till I see you in the next episode. Thank you very much. Have a great day.